Jim Alfrey. Thank you for coming to our Roth conversion webinar. This is a very timely presentation. We'll try to keep it short. We'll keep it to about 30 minutes. We also have Michelle here who will talk about fair market valuations a little bit. But here's what's kind of fun about this whole presentation. We have an opportunity this year to convert our traditional IRAs, old 401ks, into a Roth, which up until this year we haven't been able to do. There was a $100,000 adjusted gross income limit for all of those who were wanting to convert their traditionals to a Roth IRA or a Roth 401k. And that's also new, isn't it, Jim, the conversion to a Roth 401k?
It absolutely is, Curtis.
So when we as we're talking about this, we want you to pay close attention to some of the dates and details. We believe that a Roth retirement plan, and notice I didn't say IRA or 401k, but the Roth in general, when you hear it, is a tax-free savings account. It's where you pay the taxes up front, and all of the profits and income from the investments, when you decide to retire and start taking the money out, comes out tax-free for the rest of your life, and not just for the rest of your life, but for the rest of the life of your beneficiaries. And we really want to emphasize that. This is the way you pass on a retirement plan, tax-free for the rest of your life.
Curtis, this gives people a tremendous ability to extend that as tax-free income, basically, for their generations to come. Is that true?
Absolutely. It can last. These retirement plans can last for the life of for 2 lives, the life of the person who set up the retirement plan and the life of one beneficiary. That doesn't mean it can't pass on to multiple beneficiaries, but we're talking about duration of time. So it ends up being really important to understand how we can pass these on for the rest of the lives of our beneficiaries as well. A lot of this information is on our website. Our second quarter newsletter, it's in our educational library, and the third quarter newsletter is on the Roth 401k conversions. We also have included a year-end checklist, so please go to our website and go to our library and start looking through a lot of the information there. The benefits of a Roth are really important. Money invested grows tax-free, and it gives you tax-free income for the rest of your life and for the life of your beneficiaries. There is no required minimum distribution, unlike IRAs when you turn 70 and a half or 401ks. There is a required minimum distribution. A lot of people, when they get to be older, do not need the distribution and are more than happy to pass it on to their beneficiaries, but they end up having to take money out and pay additional taxes, which pushes them into a higher tax bracket. If you have a Roth IRA, you can continue to contribute to it after 70 and a half, which is not the case with a traditional IRA.
The ability also to inherit these Roth accounts. I mean, you may understand this term, you may have heard this being called a stretch IRA. The concept here is to be able to stretch it through your life as well as the life of your beneficiary, but because it's a Roth provision, a Roth account, we have the ability to stretch that also tax-free for the rest of your beneficiaries' lives as well. When we inherit an account, beneficiaries have an interesting opportunity here. We basically keep the account in the name of the decedent for the benefit of you as the beneficiary. And when that happens, we're not allowed to contribute to the account anymore. So you can still have your own Roth IRA account, but you have the ability to still invest in the account. And so allowing these tax-free required minimum distributions over your lifetime are a fantastic opportunity.
One of the other important things is being able to list your beneficiaries without listing a name. If you know who your primary beneficiaries are, you can put comma persterpes after them, and it will pass on to your beneficiaries by lineal descendants or bloodline without you actually having to list their names. This is important, especially if you have younger family members that are still having children, and you don't want to disinherit them. So we like the comma per stirpes beneficial designation, and you can also find that information on our website on how to list your beneficiaries. Who should convert? Here's what's important about who should convert. We think young people should convert because they have a longer period of time to earn tax-free income for the rest of their lives. But even more important, we told you earlier that this was a tax-free savings account. When you make contributions to a Roth IRA, you can take out those contributions anytime. There is no 59.5. There is no 10% penalty. There is no tax on it because you've already paid the taxes on it. So if you are in your, let's say you're 16 years old, you start a job and you start contributing to a Roth, and in 10 years you need money for a first-time home. And the contribution limit today is $5,000 a year. If over the last 10 years you put in $5,000 a year into a Roth, at the end of 10 years, when you're ready to buy a house or get married or you just need it for any purpose at all, college, you can take your contributions out tax-free, penalty-free anytime, and all the earnings can stay in the account and continue to grow.
Let's give a great example of that, Curtis. We talked with we do this all day long, but we talked with a client specifically the other day who happens to have a couple of young teenagers, and they have the ability to earn $5,000 a year from a business. Because they're going to earn $5,000 a year, they now have earned income and can make a contribution into their Roth IRA, correct?
Yes.
Now that they can do that, what you're saying is effectively because it's a Roth tax-free savings account, they could put the money in, invest it in whatever they choose, and let's say they get to another point in their life where maybe they need to pull out money for education, or they'll reach a point where they're ready to get married and they want to pull some money out. Because of what you just described, we can take out our contributions tax-free and penalty-free?
At any time. You don't have to reach 59.5 because you've already paid the taxes on the contribution going in. There's never a tax. So we really like this for encouraging savings to youth. People with deductions and tax credits this year, Jim, great opportunity to convert traditional IRAs and old retirement plans, 401ks, 403bs, 457s, because you can offset the additional income with losses. And let's face it, over the last 3 years, there have been a lot of regular income losses, people having problems with homes, cars, things like that, that they're now carrying forward with their loss of investments and investment capital that you can offset these conversions against.
Yeah, you know, a lot of times we think of that probably mostly in terms of business owners, but in today's economic situation with high unemployment rates, with those things, we also talk to a lot of clients that have been out of work for an extended period of time, so their income is reduced this year. What a great opportunity to add some income back into the system that, frankly, they can then, you know, use as the Roth conversion.
So let me just encourage everybody to contact their financial advisors, who's ever filing your tax returns, and have them give you an approximation of what your taxes are going to be, and talk to your financial advisor and accountant about converting your traditional IRAs and traditional retirement plans to a Roth, and do it so that it doesn't hurt you financially, doesn't push you into a higher tax bracket.
Of course, the next category of people that would want to do a Roth conversion are those who expect future tax increases. That's about 100% of us.
Well, Jim, I think that if you're already in the highest tax bracket, you're not going to go down. And most people don't realize this, but when we retire, it is not statistically the case that people retire on less income. You still have all of the same wants and needs, so you actually, most people are retiring making as much or more income than they were when they were actually working.
Well, and at the same time, their life situation changes. Their house becomes paid for. Their mortgage interest deduction goes away. Their income may not change substantially, but their taxable income goes up. So as we have taxable income go up, and then we get to pre-tax accounts, if we don't convert these to Roth, we reach 70.5, and we have our required minimum distributions from our pre-tax accounts, our IRAs and our 401ks. We might have retirement benefits from a job we had in the past. All of those things together, many times we're talking to the clients that are in their 70s and beyond, and they're at the highest tax bracket they've ever been in.
Yeah, and this is where the clients will come in and say, I don't want to take out my minimum mandatory distribution, even though I'm 70.5. I have plenty of money. I don't need to take more out and pay more in taxes. So these Roths end up being a very, very cool deal. Those who have non-IRA funds to pay the conversion taxes is really important, isn't it, Jim?
Well, it certainly is. For two things. We don't want to really touch the principal inside the retirement plan. We really want to protect that and continue to grow that, especially where it's going to come out tax-free. The other thing is we really don't want to get ourselves in a situation where we end up taking taxable distributions out of plans just to make this conversion. It would certainly be an option, but not the preferred option.
Yeah, it kind of compounds the problem. If you take a taxable distribution to pay taxes, that's kind of unproductive. So we would encourage you, if you have money outside of a retirement plan, to pay the taxes from those funds when you convert to a Roth, as opposed to using retirement plan dollars to pay taxes, because that's paying taxes on taxes. Doesn't make a whole lot of sense. Anyone naming a trust as a plan beneficiary, it's also suggested that you convert to a Roth. Here's why. Because if you convert today and then it continues to grow, when you do pass away and you've named a trust, trusts are not tax exempt. And so when a trust, like a family living trust, inherits a Roth, the taxes are already paid and go to the Roth, or to go to the trust tax-free, because Roths don't pay taxes.
Yeah, as opposed to the pre-tax distribution, if we did the same thing and named the trust as a beneficiary, one of the reasons we suggest individual designations instead of a trust, especially with pre-tax. But if we took that distribution out of a pre-tax account and distributed it to the trust, well, then all of that is recognized income this year, and all taxes are due.
Okay, so here are two more things that, of who should convert. I think they're pretty good. Anybody who doesn't need the money immediately can convert to a Roth and start growing it tax-free for the rest of their lives. That way it can accumulate for a longer period of time. And look, because we do self-directed retirement plans, and you're listening to this because you have a self-directed retirement plan, a lot of non-traditional and even traditional assets like stocks are undervalued right now. They have lost value. If you own real estate or real estate-oriented investments, a lot of those have lost value. So let's just take for an example. Let's say you bought a property, a house, for $150,000, and it now appraises for $95,000. Great opportunity to convert it to a Roth at a lower tax rate if you're assuming that it's going to go back up in the future.
Absolutely, and again, any kind of investment, you may have a promissory note where you have lent money out, and it could be a non-performing note with a fair market valuation, which we'll talk more about. You've got the ability to convert these at today's fair market value. An undervalued stock, if you bought stock at $1 a share and today it's worth 10 cents a share, you could convert that at its fair market value of 10 cents. The summary that you're really making is that you anticipate the growth to come back up.
One of the experts that we use, Ed Slott, we here at American Pension Services are one of Ed Slott's master elite advisors. One of the things Ed Slott suggests, if you're using non-traditional assets, a Roth is a great place to put those non-traditional assets, even let's say in the event a prohibited transaction occurs. For example, let's say you put money into a Roth and you buy a piece of property, a vacation home, and then you decide to go and start to use that vacation home. That would be a prohibited transaction. But since you've already paid the taxes on it, it's not going to really hurt you to take a distribution out of a Roth in the event of a prohibited transaction. So it's just a great way to think about these Roths. They've already paid the taxes. They earn tax-free income. Taking tax-free distributions is a fabulous way to go.
Absolutely. Now, we want to kind of give you a quick reminder here that when we make contributions into Roth IRAs and Roth 401ks, we don't take tax deductions for those going in. So as we look to the future, if you convert and create a Roth account, you're still subject to the same annual contribution limits that you were in a pre-tax account, but the difference is you just won't take those deductions off your tax returns. We do want to remind you that early distributions are subject to the 10% penalty. Early distributions mean taking it out before 59.5. Now that's except for those contributions that we talked about that come out tax-free and penalty-free anytime.
Yeah, please go to our website and to our educational library to get the ordering provision, because there are parts of this money that are never taxed again, and there are parts that never pay penalties. So we want you to, it's a little hard to hit all of these points in this particular presentation, but this brings us to the great reason why we're even having this conversation. This is a very special year, Jim, for doing Roth conversion.
It certainly is. And as you mentioned earlier, Curtis, the conversion limit up until 2010, anybody with a modified adjusted gross income of more than $100,000 could not do this Roth conversion. Now, there's a difference about Roth contributions, though. So if we look at married filing joint, for example, if we make over $167,000, the law does not allow us to make contributions. So the high net worth individual, the high income earner today, may not be able to make contributions, but the conversion is a fantastic tool because of no limit.
So what we're saying, Jim, is you can make contributions to a tax-deductible retirement plan, but because the adjusted gross income limit for conversions has been lifted, we can convert any amount we want to a Roth IRA.
That's absolutely true. You can get around the barn and still get it into the Roth, can't we?
Yes, we can. And the other thing, as you pointed out to me a couple months ago, in the health care bill, IRAs, distributions from Roth IRAs, Roth 401ks, are not included in the 3.8% health care tax that kicks in 2013.
Well, that's true, but the distribution still counts as a distribution and could raise your taxable income. So if somebody took a $100,000 distribution from a taxable IRA, that would raise their adjusted gross income, thereby maybe making some of their other income subject to this new 3.8% tax.
So here we go. This is where we actually transition into the whole purpose of this conversation. Why is it important to convert today as opposed to waiting till some future date? Because we know what our tax consequences are now. We're not sure what's going to happen in the future. And with this additional 3.8% tax, we can take advantage of the conversions today of very large amounts and not be affected by these additional tax consequences that start kicking in 2013.
That's absolutely true. And, you know, one other thought, Curtis, is that probably a great reminder for everybody listening to this is that we don't have to convert the entire account if we don't want to. So now we could play kind of the tax bracket game. You know, we've got individuals that might be married filing joint, and their taxable income puts them in perhaps the 15% federal tax bracket, and maybe they've got some cushion left. So they could easily convert a portion of their account if they chose to, and basically lock in their tax rate on that money for the rest of your life.
So here's the thing. In the past, there were only a few people who could take a large IRA or a large old 401k and put it into a Roth and pay the taxes on it at that time. Because if you made more than $100,000, you couldn't do that. This year, that was lifted, so everyone who has a retirement plan can now convert to a Roth and start earning tax-free income for the rest of their lives and the lives of their beneficiaries.
We have a special rule this year, too, that really comes into play and why we want this message out. In 2010, we have a one-time rule that is available for us in these Roth conversions. See, in years past and in years to come, we'll be able to do Roth conversions, but when we do, whatever amount gets converted from a pre-tax account to a Roth account becomes taxable income. So if I converted $50,000, I would get a 1099 for $50,000, and that's going to add to my income. What the law provided with all of these changes was a one-time exception in 2010 that you can elect to either take all of that income in 2010, and for some of us there might be great tax reasons why we want to do that, or the other option is to split the income and report it, 50% of it in 2011 and 50% in 2012, which now would change the amount of tax that we may have to pay on that, and certainly gives us time to do that. The added benefit of that, as we see what's going on in the Congress even today as we record this, is there's an opportunity where we may have the Bush tax cuts extend for 2 years and then still be able to delay or defer the payment of those taxes and still be at lower tax rates while we're doing it.
This is the great opportunity. Now, one thing we're always asked, since this has become available, can I pay some of the taxes in 2010, some of the taxes in 2011, and some of the taxes in 2012? The answer is no. You have to choose, do I take the income on my 2010 tax return, or do I split the income in 2011 and 2012? You can't do both. And one of the other things that we're being asked is, does this money, is it the taxes that we're paying, or are we taking the income? And the answer is, we're actually taking the income on these distributions. We're not taking the taxes. So whatever tax rate you are in 2011 and 2012 is what you're going to be paying the taxes on, or is the amount that you're going to be paying the taxes. We believe that the taxes are on sale. We've been promised by all of the economists and our government workers that taxes are going to go up. It's just a matter of time. And quite frankly, do you ever think that your taxes are going to be going down? Now's a great opportunity to get with your tax advisor and go over these and figure out, or go over this and figure out what you think your tax bracket is going to be, and make that decision to convert today and start earning tax-free income.
Absolutely. You know, our next point here is that we actually have an IRS.gov printout, and we're making this available on our website and our education library as well for you to refer to. There's an October 8, 2010 printout from them, and again, we're going to post it on our website that goes into this. 2 or 3 important points of this 2010 conversion. To be very clear, if you're going to do a conversion to a Roth, it has to occur in the tax year 2010. So no later than 12/31, this conversion would have to happen. Many times we're asked that question because of the traditional IRA contribution rules, where they're extended until April 15th of next year. That does not apply to conversion. So we need to be sure about that. More information about the spread of the income over the 3 tax years is in there.
Here's why it's important to think about this right now, and even to do it right now. Even if you don't know what your tax consequences are, you have until your filing deadline, including extensions next year, to undo this conversion if you decide you don't want to pay the taxes, or if the asset, if it's a non-traditional asset, or a traditional asset like a stock or a mutual fund, if they happen to tank before your filing deadline. So let's say you have a piece of real estate and it drops even farther than it is today by your filing deadline. You can do what's called a recharacterization. In other words, put it back into the traditional IRA as if it never happened and not pay the taxes on the overvalued amount. Same with a stock. If you convert a $100 a share stock and it all of a sudden drops to $50 a share, by the time your filing deadline comes around, you can move it back into your traditional IRA account and not pay the additional tax on that drop in value. So please keep in contact with us. We're happy to take your phone calls and discuss this with you at any time. In-kind distributions or in-kind conversions, you can convert assets like houses, stocks, mutual funds without liquidating them first. So just remember, there are a lot of options here, and we're happy to talk to you about your specific options.
I think you're saying there's no limitation on the kind of asset that can be Roth converted. If it's in the plan, it could go into a Roth account. Is that correct?
That's correct. And we're going to have Michelle talk to us for just a quick second on market valuations, because here's the thing. When we do a conversion, we have to have a legitimate, fair market evaluation of the asset.
First, let's discuss what is the meaning of a fair market valuation. The fair market value is the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of relevant facts. This means that although you are required to give an annual fair market valuation on your self-directed accounts to your administrator, in the event of a taxable distribution, the standard is higher. For example, in the case of real property, on an annual basis, perhaps an acceptable annual valuation would be the tax notice from your county appraiser with a realtor's opinion. Those two things would be adequate for an annual fair market valuation. But in the case of a taxable event, which is the case with the Roth conversion, you would have to meet a higher standard, which means a certified appraisal would be required, and it might be nice to also throw in the county assessor's appraisal. So you understand the difference. It's more expensive, but it is more highly valued and a more accurate valuation when you have a taxable event.
So, Michelle, this becomes more like a circumstance outside of a retirement plan, like a death in the family and a transfer of an asset, where now the IRS has a higher standard where we have to actually get an appraisal and have a document because we have a taxable consequence that's involved, as opposed to just a reasonable value.
Absolutely. And we want our file and our clients to meet the highest standard on the valuation process, because that is the amount on which you will pay taxes.
So there are a lot of different assets, a lot of different types of valuations that we might have to get, because each different asset requires a different expertise for that valuation.
Right. Let's look at one more example. A lot of our clients might have an LLC. The IRA owns an LLC. Therefore, the manager of the LLC should provide to its members on an annual basis an annual report that shows a balance sheet that lists all of the underlying assets of the LLC. It might, a fair market valuation on an LLC would include a balance sheet that shows all the underlying assets. It would also perhaps include a letter from the manager of the LLC that verifies the fair market value of the LLC. That is a different value than you will see on a K-1 report. Jim, would you like to comment on a K-1 report?
Yeah, a K-1, for those involved in LLCs, a K-1 is like a W-2 or like a 1099 that we might be used to in other environments. It's really just a tax reporting instrument for the income for the current year. So the example of an LLC that maybe makes zero income this year but has $10 million of assets, the assets are still worth $10 million. Even though it made no income, the K1 is really not the instrument. So we're really looking at the business valuation. And when you look at this screen and you see the kind of things that LLCs may own, we have LLCs that own real estate inside the plan, that own promissory notes inside the LLC. With all of these things out there, what we're really doing is saying, if we have an LLC, we have to value the whole business and all of the assets in the business, not individually the underlying pieces of the LLC.
I just want to bring up that that there are certified evaluation experts out there that have taken classes, and they are experts in different fields. Also, on privately held stock, you should be able to get shareholders' equity from appraisers if the company's large enough. Just remember, we want to provide enough documentation to justify any taxable event. We don't want to fudge on this. We don't want to pretend. We want to use the best documentation that we can possibly do for these taxable events.
I would like to conclude with the fair market valuation is the single most important process in a Roth conversion. Your file must be ready to withstand an IRS audit. This is a taxable event.
Great. I'm going to have Jim go over the next two slides, which are just some very cool ideas for using your Roth and your Roth conversions for.
Okay. The first one is an example of how a client might be using a Roth IRA or a Roth 401k to their own personal advantage in the long term. We do know that when we buy an asset inside the plan, we can't use the asset itself. We can't personally benefit from it. That would be a prohibited transaction. But as a long-term strategy, let's say that my Roth account went out and bought a beach house. And why? Because it's on sale today. I can buy it at a tremendous value, and my long-term benefit might be that I want to keep that as a second home later when I reach retirement or when I reach the age of 59 and a half and could take the asset as a qualified distribution. I wouldn't have to sell it. I could keep it and then use it personally. So that's one option with this, and a great way, because all of the value increase. Let's say I bought this piece of property for $100,000 and later distributed to myself at a $500,000 value.
At retirement.
At retirement. I would still do a fair market valuation and have an appraisal for $500,000, but because the Roth account opened it, it would have a taxable consequence of zero. What a fantastic opportunity. The next slide beyond that is we talked about the ability to inherit these plans. Now we're going to put those two thoughts together. What if I wanted to have tax-free income for the rest of my life? My Roth account could go buy, an example like this, a commercial building, an office building that had a steady income stream coming in. When I retire, I could continue to live off that income stream. The asset would still be held by my retirement plan. The money would come in. I would take the cash out as a tax-free distribution for the rest of my life, and then via the fact that we can stretch these IRAs and I can pass them on using per stirpes on to my future generations, to my beneficiaries. Now they would have tax-free income for the rest of their life as my beneficiary.
It's a fabulous tool. These Roths are great. We think this is an appropriate time to talk to your financial advisors, your accountants, your CPAs, your tax attorneys, and see if conversion would be appropriate for you. Should you convert? Here's some questions to ask. When are you planning to take Roth distributions and start living tax-free? Immediately? 5 years? 15 years? These are questions you need to ask yourself. What do you think your future tax rate will be? Does anybody think taxes are going to go down? And where is the money going to come from to pay the taxes when you convert your traditional retirement plan into a Roth? We think the best option is funds that are not already in a retirement plan, because you don't want to pay tax on a tax when you take the money to pay the taxes. Think about a partial conversion. As Jim mentioned earlier, maybe if you have a $100,000 IRA or a $50,000 IRA, maybe you don't want to take it all this year, only a portion, and then in January take another portion and convert that. so that your tax consequences are not so heavy. So you can pay the taxes with outside monies as opposed to monies coming from a retirement plan.
That's true. And ultimately, what's the goal? The goal is to reach our retirement age to where we can have a qualified tax-free distribution out of the Roth. So for everyone listening to this, we're going to be in different circumstances and situations, different ages, different tax brackets, whatever. But we believe that this Roth conversion, the Roth account, is a fantastic tool for every person, every income level, every age. We think it's a fantastic opportunity. We encourage you to look and see how well you could benefit from it.
Thanks for spending your time with us. We appreciate it, and please go to our website and print out the or look at the information on in our educational library. The IRS.gov Employee Plan News, October 8, 2010, fabulous little document, and Publication 590, which we send out to all of our clients that are new clients, has a lot of information on Roths and Roth conversions.
Thank you very much.